There are two different market states for every type of market out there. The first state is a trend, which is a consensus by market participants that price will go in one direction. The second is the sideways state, a trendless period where the market consensus about direction is not clear. During an undecided sideways period, some traders think that price will go up and buy, some think it will go down and sell accordingly, and some are undecided and stay out because the signal is unclear. The result is a trendless chart, where price movements form sideways patterns without showing a clear direction. Since many traders stay out during these periods, it takes less financial power to move the market in one direction, which means that price moves are often hectic, short in duration and hard to predict. This is usually not a good time to enter trades, although there are some tactics that could make use of a sideways market, swing trading for example. The typical market behavior behind these two price patterns is fairly easy to understand. Accumulation is the state before forming a new trend. Run up or run down is the state of a trend, and the trend exhaustion is the end of a trend. After a period of undecided sideways market activity, a new trend starts to form on a chart, with traders eagerly waiting for a new trend so that they can profit again. As more and more traders realize a new direction, they start to jump in, trying to profit from a new move. This is the accumulation period where a new trend starts to appear. As more traders jump in, this enforces a new trend even more by making it a self-fulfilling prophecy. This period is called the run-up for an uptrend or a run-down for a downtrend. The run-up or a run-down is the most lucrative period for trading because the majority of traders easily spot a new direction and jump in with enthusiasm as a consequence. As they jump in, they in turn enforce a new established trend direction. There is no sense to sell during an obvious uptrend, because you will probably lose money. As a large majority of traders think that way, you should enter into a trade during such a period, because your odds for a win will be high. Remember, you are committing a trade with a favorable risk-reward ratio. That is a safe bet. You always risk the same percentage, but your odds to win are more favorable than when entering a trade during less favorable periods. After some period of time has elapsed, the trend starts to slow down. Traders who jumped in early start to lose confidence in a trend, choosing to close or liquidate their position in order to rake in profit. As more and more traders close their position, the trend slows down even more. This period is called trend exhaustion. After some time, an exhausted trend creates an undecided sideways market, which is actually a period of pausing between two trending periods. After all, traders need a break so they can prepare for new profits during the next period of a trend. A word of caution: do not trade during major events and economic announcements. If you bought US dollars and the Federal Reserve announced a rate hike counter to expectations, a sudden unfavorable move could wipe out your profit in a matter of seconds. You may even end up with a loss. Important announcements are often unpredictable, so it is good to avoid trading during such times. You can see an announcement calendar on several sites, such as dailyforex.com, or simply Google Forex Economic Calendar. Main announcements are usually made twice a day during the same time periods. As a rule of thumb, if the announcement has a high importance sign on it, try to avoid being in a position during that time. Another problem is that during such an event, a buy-sell spread broadens because brokers want to protect themselves from sudden moves. It may go against you, so it is a good practice to stay out if you can. One final word: Do not use contrarian trading tactics. Some traders try to predict the end of a trend as they bet on a trend reversal. The chances are, however, that you will lose more than you profit from such tactics. Traders call this catching a falling knife, which describes how dangerous and hard it is. As you can see on a chart, a trending period lasts longer than a trend reversal period. So your statistical chances to nail the reversal of a trend are slim. It is best to go with the flow because a good trend has a momentum that is not easy to break. A trend is valid because the majority of traders think so. If you try to bet on a trend reversal, you are on the minority side, and the chances are you will be overrun.